Hi, it's Jack Snowden with Thomas Point Financial near Annapolis, coming to you with a brief market and economic update. The first 8 months of 2025 have certainly been eventful. We've seen the arrival of a new president and several impactful policy changes, including shifts in trade, tariffs, and income tax policy. While we typically expect the cost of tariffs to be passed on to consumers, so far, a portion of those have been absorbed by our international trading partners. Over time, we may still see some of these costs trickle down to consumers, but that remains to be seen. The recent passage of the One Big Beautiful Bill should be supportive of the markets over the next couple of years, provided that concerns around the growing U.S. national debt do not escalate to the point where markets lose some confidence and interest rates begin to rise. Earlier in the year, after the tariffs were announced in early April, the U.S. stock market, as measured by the S&P index, fell about 19%. However, due to delays in implementation and progress in trade negotiations and a solid corporate earnings backdrop, markets have since rebounded and appear more tolerant, if not comfortable, with ongoing tariff discussions. We are near all-time record highs for the U.S. stock market, especially for large U.S. companies. Economic growth, as measured by gross domestic product, has shown signs of some slowing in the first half of the year, averaging about 1.5%. And while this is the case with reduced regulation and policy changes to taxes, it is possible that it may reignite economic growth and unleash what some market participants called animal spirits. Looking ahead, the Federal Reserve is expected to reduce short-term interest rates as early as September. Employment data has softened slightly, though it remains strong overall, creating room for this potential rate cut. Lower interest rates would certainly be a welcome development here in the U.S., as it would reduce borrowing costs for both companies as well as consumers like you and I with mortgage rates. We'll look forward to seeing if the Federal Reserve does cut rates in September and possibly again once or twice more before the end of the year. We'll have to wait and see. We're now entering a seasonally choppier period for the markets. Despite that, we encourage you to maintain a long-term perspective as we remain constructive on the markets for the long term. We thank you for tuning in today. We hope you will enjoy the rest of your summer and the start of fall. And thank you again, and goodbye for now.